Welcome to Breaking Banks.
Well, CRM, those three little initials are some that are probably recognized by just about any financial institution out there. I don't know that I can think of one who either hasn't recently done a CRM project, currently working on one, or evaluating one. And yet it's a tool or a process that I think is often misunderstood. So Joe Welu is the CEO and founder of Total Expert, which is a CRM, but we're going to kind of go deeper than that. Joe, welcome back to the show.
Hey, thanks for having me, man. Really great to be here.
Glad to have you back. You were on with Jason last fall, and you had a great conversation about really focusing on customer success and customer journey. And I'd like to pick up on that conversation because, if there's a term, maybe less hackneyed than CRM or more so, it's cross-sell. This idea, right? Every institution is trying to cross-sell. Hey, our customers have X number of products with us, and we'd love it if it was Y number. And so let's just go push some more products to them. And not only can that go horribly wrong, Wells Fargo.
Horribly wrong.
Yeah.
Yeah, exactly.
But even if it's not jamming products, it's still kind of an ugly customer experience to just say, hey, you bought a product from us, and now here's a bunch of others that we think you might like. So can we unpack that a little bit today? Talk a little bit about how do we use tools like CRM to really build deeper relationships with our customers, retain those customers, and sell the right products for the right reasons at the right time, because it's really solving another customer need. Because at the end of the day, that's really what customer experience is all about, isn't it?
Yeah, it absolutely is. And really, we oftentimes talk about the fact that CRM is really somewhat of an outdated word in terms of the way that the CRM products were initially invented to really track things in terms of progress. And now today, particularly in banking and lending, really your CRM, your customer engagement platforms, your marketing platforms, all of those things really need to work together to get a really deep understanding of each of your customer relationships and then help you take action on those things, right? So it's things have evolved so much from a technology perspective, but the conversation that we started to have really around cross-selling and that word, I don't really like that word either. I think about the vision for so many of the organizations that we partner with and just colleagues and people that I talk with is, look, we want to deliver the perfect customer journey so that we can have a lifelong relationship with every customer. And the perfect customer journey should really mean we're helping them accomplish their financial goals, their financial needs, those milestones, those important life milestones, right? So you really want to approach it from that perspective, kind of that human first perspective, not product first, if that makes sense.
Well, it absolutely makes sense. And I agree with that. I think one of the reasons both of those terms are so often misused is because a lot of institutions think about it internal first.
They do.
Right?
They think product first, not human first, right?
Right. Yeah. Product first. And what we want out of a customer relationship is what we want out of the customer relationship, right?
Totally.
How much profitability can we get from that? How many more products can we sell? And I take also your other point that multiple systems really have to be able to work together. So it's not just a repository of who are the customers and what are their contact information and what are the products that they have with us. It's really understanding that journey in as close to real time as we can get it, right? Because things change.
Right. Well, it's really going a click deeper than that. Even it's really about, as you're bringing that data together and you're looking at a customer as, and I believe there's levels of maturity here, right? In terms of being able to look at truly a customer 360 view. But as you're bringing data together, then it really becomes about what are the insights that I can get from my data that I have on my customer, what the customer's told me, any above board third-party sources that help really enhance my view of that customer. And so then it's taking those insights and then using those insights to alter how you communicate and engage with that customer, not only on the channels, but also about what you're talking to them about.
Right. You talked about that path before, right? Data to insights to action, which leads to the outcomes. And to your earlier point, it's understanding what you even want those outcomes to be, right? Not just capturing any data and, gleaning any kind of insight and pushing any kind of action. It's really beginning with what is a good outcome for that customer. So what's a good example of an institution that you've seen that have done that well?
Yeah, so we've got some really great partners, customer partners of ours that are doing some really cool things, and a good example would be we're working with actually a handful of organizations that are looking at all of the customer data, and I'll give you some examples on a lending side of things. They look at, first of all, this organization does a lot of consumer business. So they have a mortgage team, they have consumer finance teams, right? And so they're looking at the homeowner, the mortgage product. They're looking at the homeowner that has a mortgage, has equity in that mortgage, and then maybe also has some revolving debt, right? Or maybe has a very small cash balance, right? And so they're looking at, you can now bring in how much equity approximately one of your customers has on their home, right? And so if you think about a customer that maybe doesn't even understand that there's pretty seamless ways for them to be able to access that equity, such as a HELOC, right? An equity line of credit, for example. So that's a creative way that some of the banks are working with us and partnering on taking that data around equity, understanding which customers would benefit from a home equity line, and then making that offer in a very elegant way. They're educating them about what it means, what that product can do for them, and then they're getting really personalized on the offers that they're delivering out.
So that's a good example of integrating external data sources. So it's not just the data that we have on our customers today. It's how do we integrate that with things that are happening maybe outside of our four walls to be able to help us create some of those insights. Now, you talked about an example there, kind of a lending-based example.
Sure.
Is that most of the examples, do you think, or are we also seeing opportunities from, more depository-oriented accounts, or where we've got transactional data that's leading us to more insights?
Absolutely. We've got another organization that we're working, another bank that we're working with actually, that they are looking at the depository base of customers, and they're making referrals and suggestions over to the wealth team. This particular bank has a wealth management organization, and so they're educating the customer on, hey, here's some options for us to take care of your financial needs more holistically and put that money to work for you. So it's a very simple, really simple customer journey to deploy. You have pretty easily access to deposit level data and understanding, who has maybe a recent influx of cash that's just sitting there, or who has had a balance that they're not spending, but it's just sitting in the bank earning, next to nothing in terms of interest rate. And so that example is really thinking about what's the best possible outcome financially that I could deliver to that customer, right? If I think about my mission as a bank or credit union is taking a customer and getting them the best possible scenario of financial health and wellness, right? That example really goes towards that. It benefits the bank and it benefits the customer. So,
well, and you've been talking about financial literacy as a way of improving customer health. How do you use data and insights to drive financial health through a process like this?
Yeah, so I think it goes into customer journey orchestration. First of all, customer journey mapping before you're doing that, right? And then saying, okay, what can I understand about my base of customers, right? So example would be, I've got 50,000 customers. I'm going to look at those customers. I'm going to break them down into cohorts. I'm going to look at, the millennials, the 20 to 25-year-olds potentially don't have a home, you don't have much credit. That's one potential journey. And then I've got another journey that, hey, they're a small business owner, they're in their mid 40s, they've got a home plus an investment property plus an equity line, and they have larger cash balances. That's another scenario, right? So I'm not going to communicate with both of those personas the same way, right? So I'm going to start educating my younger cohorts of customers. I'm going to start educating them on financial health, right? What it means why owning a home is important. I come back to that a lot. Why having savings and liquidity, right, matters. Why keeping emergency savings matters. Why having a better credit card rate, or a better, a certain type of credit card. A lot of our lenders, or a lot of our banks rather, have good, robust cards businesses. And so they want to help educate those customers on how they can deliver benefits. It's really about sharing knowledge and following what we call educate, engage, and then advise, right? So I'm educating the customer on kind of the different types of financial milestones and financial literacy type of things. And then I'm engaging with them, communicating with them based on what they do, right? If they reach out, if they open a piece of content, if they fill out an inquiry, and then I'm giving them some advice on the right product or service based on what we've learned through that conversation.
So how do they iterate in that process of, I want to come back and talk about the cohorts in a minute, but what you just said there was, educate and engage. And so how are the institutions that you're seeing kind of testing different messages and figuring out what's working and what's not, and how do we tweak this and what works for this cohort versus another cohort?
Yeah, so that's the key word is testing. So first of all, having the perspective that actually the bar for making really meaningful progress for most banks is surprisingly pretty low, right? In terms of they haven't really done a great job of communicating in a specific way to the different cohorts of customers, right? They've done a more product first. We have this many products. Let's blast these out to our customer base. And we're going to get some of them that say sign up for a new credit card, right? And so it's taking a step back from that and then doing that iteration. So you're running some tests. We have one customer that does just a great job at putting together financial newsletters and sort of what's going on, just high level economic updates, right? Those types of things. And then they'll tie in other, products and offerings strategically, but not right away, right? They're building value. They're creating value for that customer by giving them educational type information. And then over a period of time, they're then making a recommendation or a suggestion on a product that could be helpful to them.
Are you able to kind of measure and figure out what that timing or cadence should be? Like we know that, we pushed this too early, so we should have had a few more educational pieces before we went for the sale here.
Yeah, absolutely. So one of the things that we do that's great, and certainly this is not a technology commercial for Total Expert. One of the things that we do really well is we have a lot of data across the customer journey. So if you think about, let's say you have a 2 to 3 or 4 year even journey for a particular customer, and you have different messaging based on what's happening, and then you have different milestones throughout that process. So we can track very visually, you can track where customers are getting stuck, where they're maybe opting out of information. So you can track opt-outs, you can track engagement, right? You're seeing if they're opening the content, if you're doing SMS, if they're responding to texts or emails, right? So you can really look at the data and say, this is working or this is not, with some very basic analysis. You don't even need a extensive analytics team to really look at some of the basics. And then you're making tweaks and adjustments based on what the data is telling you.
Well, and let's then talk about those cohorts a little bit. How I know you've seen a range, right? Some organizations are really good at this, some are not. On a scale of 1 to 10, what do you think the average institution is that you work with? How sophisticated are they at understanding these different cohorts?
So I think it depends on the size of institution, okay, and it's not always the same. We've seen $700-800 million banks that are shockingly fairly sophisticated, right? And we've seen 10 to $20 billion banks that are shockingly not very sophisticated at all, right? They've done a lot of M&A work to build the customer base. And so we've seen, I would say as an average, it's certainly below 5 if I just had to baseline average it out in terms of sophistication and how good they are at it. And I think a lot of times what has happened is they've made good progress maybe on investing in some analytics or some data. They're getting some insights, but it's actually then activating that data and taking action on those insights. That's where they all fall down. And we see this up and down size and sophistication of institution. They have analytics, even if they have the deep analytics, really the ability to then drive the outcome, meaning change the communication, what the person who's responsible for maybe that customer relationship, if there's a personal banker, or if there's an advisor or a loan officer that has that relationship, how are they then delivering those insights into the hands of those people so they can have the right types of conversations? They're really, really shockingly bad at that, that last part.
Yeah, my experience is it's certainly well below 5. Some notable exceptions to that, but most
Totally.
most not so good at that. And when I think about what do I want from a CRM tool, but also a CRM process, right? And how do I want to improve the retention expansion of that? It's kind of the same thing if we think about the individual relationship managers within the organization. Some are
Yeah.
really good at it. And in my mind, doing this right means we're just really scaling the best attributes of the best relationship managers.
100% accurate. That is
Yeah.
exactly the right way to say that.
They know how, like, kind of what you were just saying, which customers ought to get which message, kind of where they are, where their mind is. They're not ready for that yet, and whatever. Um, and here's where external data can also be really helpful. So kind of back to that, where's the average bank today? How much of how many of them are leveraging external data? Because that's where we can really get a lot more sophisticated at understanding those cohorts. Because my sample size might not be, large enough to help me, but I could leverage a much broader set of data.
Yeah, I would say that in some capacity, there's maybe half that we have seen from the base of organizations that we work with. Maybe half are getting some type of external data, but then it's really pretty dismal in terms of what they're actually doing with it, right? So even if they're getting it, let's say they have a relationship with the credit bureaus, or they're getting valuation data or other types of profile data that's available, they're not really doing anything meaningful with it in most cases that we see. They've failed to actually have it deliver impact, right? And so the great relationship managers in banks and organizations are instinctive about taking care of the customer needs, communication, engagement, follow-up, right? All of those things, right? But then if you think about, okay, how do you take the best possible experience where, my best advisor, my best relationship manager, they almost kind of anticipate the needs of the customer, right? They're having conversations, they're thoughtful. Then how do you take that and how do you do that at scale? And as you said, it's really putting what we call intelligent automation, so workflow and process in place that's driven by data, to then enable maybe the average or below average relationship manager to have that same process. And then organizationally, I have visibility into, are they following the process or are they not, right?
Well, and you started in the mortgage side of the business where the products are,
Yes.
fairly homogenous, and maybe some of the journeys and some of the pieces were pretty predictable. But now, as you're expanding and working with
Mhm.
different parts of banks and credit unions, you mentioned wealth earlier, you start to get into some more not only sophistication, but some more variability and some more.
Lots of variability.
Yeah. So what are you learning around that? And I'm curious, how far along are you on the commercial side? Because I think we're still in the super early innings of all the things that we've just talked about applying to small business customers.
Yeah, so we are definitely early stages on the commercial side. We have organizations that are doing some really cool things with their small business customers in terms of looking at them holistically and saying, hey, I want to serve all of their financial needs, not just their commercial loan, right, or their treasury, right? So we have some scenarios where we're really seeing some cool stuff happening there. But it is definitely an area of focus for us over the next couple of years in thinking about, there's just, as you mentioned, it's super early innings and there's so much that has just yet to be done on the small business side of things. Consumers certainly ahead of where they are.
Well, and when we think about that complexity and variability, that's really where the opportunity for technology lies, right? We just said that, this is about leveraging the best RMs, and the more complex those relationships are, the more opportunity we have to do it right by adding technology.
Yeah, so we have an offering that we've just released called Customer Intelligence, and Customer Intelligence is essentially our umbrella name for external data sources that can help you create a more holistic financial profile of every customer, right? So our vision, and I would say our shared vision with a lot of our customers, is saying, how do we have the most comprehensive financial profile for every person in business that we service, right? And if I have an extremely robust, comprehensive financial profile, then I can really anticipate needs. I can enable my people to have higher quality communication, right, with them, right? So if you think about, we talked about right before we started recording, talked about having deeper relationships and stronger relationships. And so if you think about it at a basic level, what's fundamental to having a great relationship, whether it's business or personal? It's really great communication and high quality engagement, right? If you think about it. And I think it's really the same for customers, banks customers, and whether it's business customer or consumer, is they want high quality communication, but not annoying. And they want engagement that is actually intelligent and thoughtful, and not just, you're trying to sell me something.
Right. No customer wants that.
No customer wants that.
We're maybe last thing, because you open up another can of worms, and maybe we'll get into it next time we have you back. But as we talk about these different business lines and the different cohorts and the different needs, I mean, that also makes me think of the different silos inside the organization. So we have different managers, different decision makers, different data sets, different tools and technology. Talk about that challenge and how organizations can kind of overcome that, because the customers don't care about your business lines and your silos.
They don't care about how your P&L works, right? They care about what's important to them. And so the answer, JP, is ultimately there isn't a immediate quick win way to solve that entirely, right? It is an iterative process. And what we have learned, the organizations that I believe are on the leading edge and really the high performers, they take it bite by bite, right? They're looking at it, and we've seen this change over the last few years to where banks used to really look at 18 to 24 month big implementation projects, to now it's looking at a very narrow slice. Maybe you're picking out one cohort of customers, you're picking out a specific customer journey, and you're just going to get that live and get some impact in the next 90 to 120 days, right? And then once you do that, you do another one. And that has been, and that means you're getting the data sources that you need to solve for that specific scenario, that specific customer journey, right? It might be, just for one or two types of products or one or two different cohorts, something very simple that can be accomplished. And then you're building on that success. And that's really what we have seen to be the secret sauce, is looking at it from a very iterative, bite-sized approach.
Well, I think that's good advice for any form of digital transformation, right?
Yeah.
Just get some small wins and keep building on that. So maybe last thing before we wrap, what advice do you have for institutions that are hearing this conversation, thinking, okay, what is that first bite-sized step that I could take tomorrow?
Right. So yeah, first bite-sized step is number one, just make sure you have clarity as an organization on what you want to be focused on, right? Are you focused on your commercial business? Are you focused on both commercial and consumer? Really understand that, right? And then I think the first step is to start looking at your customer journey. It is really about looking at the customer journey and identifying the gaps that are there currently. The fastest way to add growth and create growth for an organization is just to plug the gaps that are there. And meaning there's nobody following up with them from point A to point B, right? And so you can have a lot of progress from just filling in those gaps. And that is literally, it sounds really basic, but getting a small team in a room with a whiteboard, looking at each of the cohorts and saying, okay, what's the process they go through? What would we like the ideal outcome to be? And what are the barriers to getting there? And that's the way to get started.
Well, that's great advice and a lot more to unpack. And so we'll have you back to talk about that next time. But thanks for joining us, Joe.
Thank you, JP. Really appreciate it.
All right, check them out at totalexpert.com. There may be nothing higher on the hype curve right now than NFTs, non-fungible tokens. Jason and Amber were at South by Southwest recently, and there were a lot of sessions on NFTs there. But how do we separate the hype from the reality? And what about some of the unknown aspects and the legal aspects, the regulatory aspects of this? Dara Tarkowski, host of the Tech on Reg podcast here on Provoke.fm, gets into that with Lamont Black, professor from DePaul University, to talk about how regulators are going to treat this new asset and what are some of the risks that we need to take into consideration.
Hi, everyone. Welcome to another episode of Tech on Reg, the podcast that explores all things at the intersection of law, technology, and highly regulated industry. Today's episode, NFTs, or Nifties, as many casually refer to them. Lots of hype, and understandably so, particularly because, people sold one of those for over 69 million bucks, and that's a lot. So from art to music to video clips, are Nifties the new medium for art distribution and collection, or is this just another fad fraught with legal complications? Let's see. Today we are joined by Professor Lamont Black, Associate Professor in DePaul University's Department of Finance and Real Estate, who also teaches a graduate school course on blockchain, to explore this topic with us. What is this new technology? How is it changing the way we purchase high-value items? And to help me wrap my caveman lawyer brain around it all, welcome to the show, Lamont.
Thank you, Dara. It's great to be here.
So I think a fair place to start is, Lamont, can you help my listeners understand what is a Nifty?
Sure. So my guess is many of your listeners have heard about them because they've been in the news quite a bit recently because of some of these big art sales. But I think conceptually, it's helpful to just step back and think about the underlying terms and what they mean. So fungible is a word that means, something that is exchangeable or replaceable with another item. So you could think about maybe like a $20 bill being tradable for another $20 bill, and it, the user or the owner might be indifferent between those two pieces of paper, or some commodity or shares in a company. But
and by the way, we're talking about fungibility because NFT stands for non-fungible tokens, right?
That's right. So a non-fungible token is a token that is not exchangeable or replaceable. And what's unique about them is that they create an ownership to some digital asset. And this, I think, is particularly important right now because as we're moving towards a more digital economy and shifting from physical assets to digital assets, there's a lot of interest in how do you establish ownership over a digital asset. And, digital assets would seem to be more fungible in nature. We can copy things and share them. We do that often, day to day with different files on our computers. And so if we want to have some unique ownership to a specific digital asset, how do we create that link? And that's the real innovation of a non-fungible token, and why people are very interested in owning these tokens and having that ownership stake.
So I just want to back up for a second. These digital tokens, these non-fungible digital tokens, they're supposed to represent ownership of an asset, right?
Yes.
But in the case of digital art, correct me if I'm wrong, the NFT isn't the artwork itself, right? It's a token that either refers to or points to the artwork. But the digital, like the actual image itself, the JPEG, the audio file, whatever it may be, it's like somewhere else. That isn't the nifty, right?
Yeah, I think that's part of why people are very confused, and I think kind of scratch their heads when they hear about non-fungible tokens, because we typically think of, like with artwork, owning a physical piece of art that you can, put in a museum or hang in your home, and it's clear that you are the unique owner of that physical object. But when you start talking about a digital object, which can be copyable or like a JPEG file or something like that, then simply, having that JPEG on your laptop would not be a unique ownership, because that same JPEG could exist on someone else's laptop. And so it's really not about the actual digital file. It's more the actual ownership record itself, which is unique.
So the one analogy that someone used with me was a baseball card analogy. So in my mind, baseball cards, hundreds of thousands, millions of baseball cards, the same baseball cards are printed all the time, but you might have one with a unique signature. So to me, that signature, that unique token, to me is sort of like the equivalent of a baseball card signature. Am I thinking about that wrong?
No, I think that's exactly right. And I think that's where we're seeing a lot of the action in the non-fungible token space is in sports memorabilia. So NBA Top Shot was actually one of the first examples I heard about from my students. I had a student in one of my undergraduate classes who had bought one of these NFT videos of a slam dunk from a basketball game. And he, through Zoom was able to show it to the rest of us. And so people are interested in having this kind of unique memorabilia. And it used to be the physical baseball card, but now like a little video clip. But just like you were saying, it's not the actual clip itself. It's this unique record of ownership, which would be like a kind of like a sports signature. And I think what's super interesting about that is how that then relates back to blockchain, because blockchain is the underlying technology that makes non-fungible tokens work. And a blockchain is basically a ledger of signatures that record some transfer of ownership. And so I think we've come to get used to this idea of signatures as it relates to like transferring Bitcoin on the Bitcoin blockchain. But because, the like Bitcoin white paper refers to signatures in that sort of way. And so here we're kind of thinking about something like an athlete signature that would then signify this is a unique digital asset, and this individual has some unique ownership of that asset.
So Lamont, you've used the word unique like a lot of times. And that, I think that's part of what makes my lawyer brain hurt. And I think a lot of people get confused by saying, oh, you have this unique asset, this unique asset. You may have a unique signature, but like the clip isn't unique. The JPEG isn't unique. So it sort of brings me back to the question, I recently listened to an interview that you did for WGN Radio about this very topic. And you made a statement during that interview that ownership was the name of the game. So if ownership is the name of the game, when you buy an NFT, My goodness, what the heck do you actually own? My legal colleagues and I, there's 5 different lawyers will give you 5 different answers. So what do you think?
So, I think if you think about it from the perspective of blockchain, you can think of it as like a digital wallet, and you have this token, this non-fungible token, which is in that wallet. But then I think the question is, well, what is the relationship between that token and this digital asset? And I think it sort of gets into this interesting evolution that we've seen in blockchain, where it's transitioned, I think, from just a transfer of value to being able to do additional things on that blockchain. So if you think about like Bitcoin as being a blockchain which simply transfers the value of Bitcoin from one digital wallet to another, well, when we started into the Ethereum sort of era, we've now been exploring all these decentralized applications, smart contracts, and really trying to build different types of architecture on a blockchain. And I think what we're seeing now with these non-fungible tokens is, how do you create a record of ownership which is unique to the individual? So there's only that digital wallet with that token in that wallet, but it might be attached to a digital asset, which then, could reside elsewhere. So like you're pointing out, the actual asset doesn't reside in that digital wallet. It is a record of ownership that resides in that wallet. And I think
part of that is because, like, from a practical matter, like, it's just too big. Right? Like the assets themselves are just too big, and these platforms were not designed to actually transfer those types of files like they could, 1/1000th of a Bitcoin, right?
Well, I think scale could be an issue there, but I think it's actually more so, with a digital asset, it's just much harder to establish uniqueness. So even if you could put a file into a digital wallet, it would be very difficult to ensure that that file isn't somehow replicated or shared or distributed to other people. And so, like, when you think about the kind of craze around NFTs or NFTs right now, there is a part of that's being driven by scarcity. There's only, a few hundred or a few thousand of any given thing that's
for now.
Right. And so, right. So if people could just simply start, proliferating these video clips or these JPEGs, then there would be absolutely no value, because then anyone could have them. And so that's actually what I think is interesting about NFTs, is it's not the digital object itself, it's this record of ownership which cannot be duplicated in that same manner.
Well, so that brings us to sort of a complicated topic. And I think a complicating factor for digital assets generally, physical assets, for example, are not fungible. Even 2 copies of the same book will have, variations, a typo here or there. The binding is different, the quality of the paper, what have you. By contrast, digital media theoretically can be reproduced identically and infinitely, and it will not vary in any meaningful way, except for maybe the timestamp for when it was created, or the IP address on which it lives, or where it was transferred. So we run it, as a result, we sort of run into, and I think this is where a lot of lawyers start getting stuck. There's lots of other areas where lawyers get stuck, but the copyright laws that exist, that are on the books of the United States right now, have already sort of had a problem with assigning copyright protections to digital assets. Under copyright law, there isn't such a thing as a unique digital media asset that can be bought and sold on a secondary market, because media files under copyright law are essentially treated as fungible. There's some exceptions to that, but it's known as the for sale doctrine. So that's sort of like the first like place where, lawyers get a little stuck, which goes back to the what do you own part of it, right? Because if you're not even getting sort of like the basic protections, copyright protections under the law for this thing that you're promised is unique, right? You're promised it's unique and you're the only one that has this particular token. As of right now, the law doesn't protect the uniqueness of that token. So what are you kind of left with?
Yeah, well, I think it's not by coincidence that a lot of this innovation with non-fungible tokens is taking off in the arts, because, if you think about the history of art, either visual or audio, we've seen this transition from physical paintings and physical CDs or LPs to these digital files like an MP3 or a JPEG. And so then, I think there has been a bit of a crisis in those markets of, how do we manage copyright? I think this history in music of like Napster and the distribution of music online, and then the implications of that for the music industry were very relevant to what we're seeing now, because I think, the music industry had to figure out this kind of new form of streaming service so that then, artists can still earn royalties, but those assets are sort of managed by a platform like a Spotify or iTunes. And so what I'm hopeful for is that this could lead to some form of kind of democratization of artistic digital art rights and distribution, where you don't necessarily need some centralized streaming service. You could have artists that are being compensated for the objects that they're creating. But then I think to your question, then the question is, like, if you own one of these non-fungible tokens attached to a work of art or a piece of music, what exactly do you own? Because at this point, in some sense, it's kind of like bragging rights or personal satisfaction. You're just
cool,
right?
Like you're just super cool and building your portfolio of nifties, right?
That's right. And so the origin of these nifties goes back to like an Ethereum, like crypto kitties, people being able to create these little like images of cats that are unique. They have, different colors. And you think, well, what's the use or purpose of that?
You're like, because I want it.
That's right. And you feel special. That's right. And so I think that's the big question in this market right now is how do we transition from it's cool, I enjoy having it, to how do I actually sort of establish value or property rights, and what rights are then can be given to a user or an owner of these different assets, because I think that transition is still pretty unclear.
For sure. I think it's definitely unclear, but I want to go back to one issue that you pointed out, and that is the democratization of art and giving artists, sort of the ability to monetize their work and, their contributions to the world, which is important. On the flip side, because I'm a lawyer and I can't help myself, on the flip side, it also sort of provides an opportunity or platform for people who want to do bad things to undermine the ability of, the creators and the true owners of that art, because anyone can create a nifty, right? Anyone can create it, even for an image that they don't actually own. They shouldn't do it, but they could create it. So are we in essence creating an opportunity and a platform to sort of undermine the entire goal of what these nifties were actually created for, and supporting artists and, the creation of a platform for, the secure transfer of, digital distribution? In some ways, nifties allow sort of infringers on that art to create art through tokens without knowledge or permission of the original artists. And you won't really know about it until like later, until like after the bad guys made a lot of money off of your original artwork, which is why I know there are so many people who get frustrated with lawyers. It's like, oh, you gotta, you're crapping all over everything and you're stifling innovation and like you're getting in the way of things. But a lot of these are really legitimate questions, because just as you want to promote the democratization and promote innovation in terms of how these tokens can be used in the right way, you also have to sort of think about and account for how the platforms and NFTs can really be used in the wrong way, which was like perfect cue. It's like, enter the regulators.
Yes.
Because anyone who thinks that they're just going to sit back and like let this marketplace sort of exist uninterrupted and undisturbed is, they're delusional, because that's not going to happen. I think what do you think about that?
Yeah, I totally agree. I think there's a lot of similarity to what we've seen with the ICO market, the initial coin offering. So there was a lot of optimism in the beginning, and there was kind of this proliferation of new coins, but then people started to realize that there was a lot of fraud. There was a lot of pump and dump to these new prices. And so with NFTs, I think we're going to see similar efforts toward fraud and short-term speculation. And I think that is often the case with new innovations. It is kind of the wild, wild west. This is kind of the frontier right now of the blockchain crypto space. But I also think that, coming back to your point about kind of, what would prevent someone from just sort of creating some new nifty attached to some piece of art, which would then potentially defraud the original artist. And
the consumer, right? You're defrauding two people.
Yes. I think that then goes back to the blockchain technology. Like, I think it's impossible to really understand how this is going to play out unless we really can understand how blockchain as a technology is being applied to this purpose. Because, the original innovation of Bitcoin was, if we're going to try and transfer some form of electronic cash from one digital wallet to another digital wallet, how do we verify and ensure that that electronic cash is actually in that first digital wallet, the seller of the Bitcoin? And that's what blockchain does. It's a record of previous transactions. You have that entire history, which is immutable, that is transparent, everyone agrees on and knows this Bitcoin resides in this wallet. And if this person wants to sell that to this person, we're going to move it from this wallet to the other. And so it solves that double spend problem. It prevents that duplication or fraud or counterfeit in the digital space. And so I think that's really what is happening with NFTs, which would be these tokens, non-fungible tokens residing in a digital wallet. And so if you are like a consumer of NFTs and you're going to buy one of these, then I do think there has to be a certain level of financial literacy almost to know that what it is you're buying, and to ensure that this wallet that it is coming out of is the actual owner of that NFT, not some sort of substitute or manufactured alternative. So if we can get to a place where that record is kind of verifiable in the blockchain and everyone knows what's a real nifty and what's a fake nifty, then I think the power of blockchain will really shine. And I think these transfers of ownership will be legitimate.
Well, doesn't that sort of, this is an analogy to the same sort of stressors and oversight and questions that many of the initial, platforms, the cryptocurrency platforms, Coinbase, Kraken, whoever it was, the questions that they were being asked, and what sort of responsibility those platforms, and to me, the same would hold true for any platform that's going to provide an online marketplace for NFT sales or purchases, to be subject to sort of like consumer safety regulations like any other sort of e-commerce platform, right? There's not a scenario in our environment, in our regulatory environment, where you just get to throw a platform up there and let people do what they do. I mean, God bless America and the freedom of contract, but like that doesn't actually exist, right? If you're going to provide a platform and a marketplace for buyers and sellers, particularly unsophisticated consumers, there is going to be a level of protection that you are going to be expected to provide. So where does that responsibility lie? Is it always going to be the end consumer? Does that responsibility lie with the platform? What are the representations and warranties of the sellers? And then what are the regulators, whoever they may be? And by the way, we don't even know which regulator is ultimately going to take ownership over this platform, because no one can decide whether or not is it personal property? Is it a commodity? Is it a security? In some situations, it may be all of the above. We don't know, because it all depends on the, I'm going to use your word, unique nature of the transactions, right?
Yes, I totally agree that, there has to be a role for regulation, just like we saw with the ICO markets, defining what is a utility token, what's a security token, what falls under, these laws, what falls under other laws. And so I think we're going to see that same evolution in the Nifty space. But what I find interesting about it is, again, coming back to blockchain technology, it allows for this decentralization. And, obviously exchanges have to be regulated, and in particular, because many people are buying these Nifties as a form of digital asset under the goal of price appreciation, earning a capital gain, turning around and selling it later, that starts to sound an awful lot like a security. And so, I do think the SEC...
Can we say Howey test?
Yeah, that's right.
Let's talk about the Howey test.
Yeah, so, the regulators are not going to just turn a blind eye to that. When these things become traded like securities for investment purposes. But I also think, if you look at the cryptocurrency exchanges and the diversity that we see there, there are sort of centralized exchanges that where you can buy and sell crypto, but the exchange itself owns the private key to that digital wallet. But there are also decentralized exchanges where the actual owner owns the private key. And so I do think that Nifties are a shift even more towards this type of decentralization of ownership, where we can have, rather than large, conglomerates owning artwork or selling rights to that artwork, that this is a way in which some of that can be decentralized and distributed. And so I view it as, a next step in this evolution of, not just doing money online, but if you think about ICOs, how do you do crowdfunding online? And now it's how do you decentralize ownership online? And I think there's a lot of potential from moving that direction.
Well, I think it's important for listeners, regardless of where you may sit in the Nifty ecosystem, a buyer, a seller, a speculator, someone who wants to invest, someone who wants to commoditize these assets. I think it's important to, as you dip your toe, think about the nature of the transactions that you want to be entering into, and think really hard to yourself. The CFTC has come out and said that they're going to put together, a very holistic framework for digital assets by 2024. And there can be there's no question that NFTs are digital assets. But also remember, if what you're doing is pooling these assets together and trying to turn a profit, and you do want to speculate on the market, be careful that you're not, accidentally stumbling upon an unregulated securities transaction or running afoul of the, securities laws. And I hate to even say this, but, my show is on provoke.fm, and we have a lot of financial services listeners. There is sort of this issue out there that some lawyers are talking about, but not a lot of finance folks are talking about. And that's sort of the notion that NFTs could be viewed by regulators as substitutes for value. And that brings up questions about the Bank Secrecy Act. That's literally the subject of a whole other episode. So maybe we'll have you back with someone to talk about that. But then we've got to start talking about, money transmission, legal compliance. And like the rest of crypto that thought it was going to, in its perfect world was going to exist without regulatory oversight, 10 years later, we see that that's certainly not the case. And I think the same will be true for NFTs, although as we were discussing before we started recording, I hope it's less than a decade before we can figure that out. So last question of the episode, and then our time's going to come to a conclusion. But Lamont, is this a bubble or is this the future?
So Dara, I think it's both. Maybe that's not
that was such a lawyer answer. That was such a lawyer answer. I don't know if to be annoyed or proud.
Yeah, maybe we're more similar than we think. So, it's currently in a bubble. I don't think there's any question about that. Just the prices that we're seeing, the millions of dollars that people are paying for artwork or even some of these video clips. So, I think it's very speculative right now. It's very frothy. And I think that's going to just have to play itself out. But I think we've seen these episodes in other forms of crypto or digital assets as well. Bitcoin has gone through a number of these cycles. And every time it crashes, people say, well, that's the end of Bitcoin. And, that proves that Bitcoin had no value. And then it comes back. And so I think we're going to...
And then some,
yeah,
right? And then
exactly.
Some.
And so I think we're going to see a crash in the NFT space. I think, there's a good chance that we see like an NFT winter or a nifty winter. Oh, I'm going to coin that. You've heard it here. Because
That's right. You heard it from Lamont Black on the Tech on Reg podcast, a nifty winter.
Yeah. I mean, we saw the crypto winter before the resurgence that we've seen recently. So I'm a tech enthusiast. I think you are too. And I think everybody is still kind of scratching their head saying, okay, well, what with a Nifty, what do I actually own? And, is this just simply cool or is it somehow some psychological value? But I think over time, we're going to see this play out as a new and interesting way of recording ownership. And so far, I think these applications to, digital works of art are super interesting. But I think about as this plays out into other types of assets and other types of ownership, that's part of where blockchain applications are starting to go, establishing ownership rights, whether that's a digital asset or a physical asset, the Internet of Things. If we can start to really come to agreement on who owns what and how that's recorded, then I think there's a lot of applications that go well beyond what we're seeing today.
I would have to wholeheartedly agree with you. So remember, listeners, before you spend $69 million on a Nifty, maybe talk with a lawyer or 2 or 5 and get some insight to make sure that you're not accidentally entering a transaction that you didn't mean to enter into. Lamont, thank you so much for joining us today. I thought this was a super interesting conversation, and we will see if the nifty winter is coming.
Sounds good. Thank you, Dara.
Bye, everyone.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.